Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next, let's call it 20 minutes here on Options Guide TV. All right, NVIDIA announced earnings, very uneventful. As a matter of fact, the market hardly moved whatsoever. And that's very odd in the scenario in that I was going to set it up so that our break even would be right at 180. And I'm like, no, NVIDIA is going to move somewhere. So either let's get a little bit more upside and have a little bit less downside. Well, guess what? It didn't go anywhere. The market actually closed about 180, pretty much where it opened at. But our butterfly, our open wing butterfly, needed the market to go up at least a little bit and not that much. We could have taken just a few points and we would have been profitable on the trade. If you closed it out yesterday on the short-term option trade, if you would have closed it out, you would have had a small loss. If you did the longer-term trade, which is the September trade, that position is still live, and I would actually just hold it personally. But in that position, you still have a chip in the chair. We're looking for the market to get back to 180. NVIDIA is down 6 points today, or 3.5%, trading at 174 approximately, and moving quickly is where we're at. But PCE came out. Markets just in general is going down. I think NVIDIA is going down with the general marketplace. It has nothing to do exactly with their earnings. They had a very solid quarter. China showed up in their numbers. The fact that they haven't been sending shipments, I don't know the exactly what's going on there, but NVIDIA, I think, will have a strong boost if they can navigate those waters, and I think that they're leaning that way. I think Jensen, the CEO, is doing a very good job of handling the politics around it. And so they're still very solid quarter. They just didn't blow the numbers away, but they had a very solid quarter. And the marketplace, I guess, reacted just muted, and I guess we'll leave it there. So I got two things that I want to do with this trade. I still want to stay bullish on NVIDIA long term. And with we're going to take time to set up, first of all, our first trade inside the what if calculator. Give me 1 second here. All right, I'm ready. Let's go. Okay, so we're in the long call vertical spread. Now, if you remember, we did this trade about a week ahead of it. And I just said that I want to get long NVIDIA going just out as a longer term basis. Now, in the options trading world, right, you can be speculative, like those butterflies that we put on. They're trying to control the implied volatility. They're trying to control the situation, in that we have a huge company announcing earnings on a Wednesday, and you have 2 days until the Friday expiration. And we actually looked at one other trade where we went out to the following Friday expiration. So with that said, this longer term option contract this longer term long call spread is going out till October 3rd. So the market has not gone with us, and there's an adjustment that I would make. And this is the part of the reason I like to set them up a little bit wider ahead of earnings, is because you can make this adjustment if things don't work out the way that you want them to. Like I said, you still got to be long-term bullish on it in order for this adjustment to make sense. But we put this trade on, and what did we pay for it? 1 second here. On our long call spread, 175, 210. Yeah, we paid. Oh, yeah, that's right. We set it up while the market was at 175. So we're not that far away from it. Right now, it's trading for 45 cents. We put it on for $1.94. The market was 180. Oh, it was $12.20 when we put it on, not $2. My eyes aren't what they used to be. It's $12.20. So right now, the market is trading for $7. So we could easily get out. We're down $5 on the trade. Not a bad alternative. I mean, we didn't it's not horrible. Like I said, Nvidia didn't move a ton. So we put it on for $12.20, and right now it's trading for $7. We're down $5 on the trade per 1-by-1 spread that is put on. Okay, so here's the alternative. Here's the adjustment. We sent this to ticket. Let's go to the trading tab. And we need to look at the October trade, 171. Okay, so the 210 strike call is now trading for 44 cents. So almost all the premium came out of that. That was trading for around $2. It's now trading for 44 cents. So here's the simple adjustment. Now, you can just go and get out of the trade. That's no problem. You can do that and say, I took my loss, and there's nothing wrong with just taking a loss and admitting that you were wrong. A lot of times, if I'm doing a long spread, if I put it on for $12, I'd want to sell it at $6. That's when I would like to get out. Right now, it's trading for $7. So you're actually getting a little bit more. So that's not a bad scenario, even though we're only trading Monday, Tuesday, and Wednesday, right? Okay. Here's the adjustment. Remember, you have the 175 strike call. So let's roll this down. You could bring in $7 and you'd be out of the trade. You'd be done. Or we could roll down and now make this a 10-point wide trade and bring in $3 more. But now if we do that, we are basically saying, I just don't want the cheese anymore. Just let me out of the trap, because we started with a $12 cost basis, right? We had a $12 cost basis. So if you roll down, you want to make sure that you can still be profitable on the trade. Market has gone against us. We're down $5 overall. We're going to end up rolling down and bringing in a net credit. So here's the roll down. And we'll look at two different ones and look at the trade-offs between the two. So I'm going to roll to the most aggressive one. I'm going to roll down to the 185. So here's the one that we've sold, right? We sold this one, so that still stays there, but that becomes a buy to close. I'm going to have to hit open, but that becomes a buy to close. And then we're going to roll, and I have to hit open because the position's not in this test account. And then we come down to the 185 and we hit the bid and bring in a net credit of $3.12, and we still have 10 points of upside. So if you do this, okay, if you just got out, you would get $7 and change. If you do the roll, you get half of that, but you still have the benefit that you're still in the position. You're saying, okay, there's no earnings catalyst anymore. We thought we could get 210 with the earnings catalyst. Well, now, since that has gone away, we don't need 210 anymore. We'll take 185. That's what it is. Like, all right, you were right. I shouldn't have gone so far out of the money with my call option. But what has happened is that call option also dried up because the implied volatility came out of it, and it's only trading for 44 cents, even though we got 35 days remaining. So we still have 35 days. We still got a chip in a chair. We still got a position. We take half of basically what we would get if we just threw in our chips and said we're done. So we get about half of that back, and we still got a chance. Now, here's the downside. Here's the downside of going to the 185. We paid $12.20. Let's say this is 320, right? So we have $9 of risk in this trade. If you take 12 minus 3, right, you have $9 of risk overall. This is a 10-point wide spread. That's the maximum it can trade for. So if you do that and it comes back, you're just making $1 or $2. So keep that. It's still better than losing 5, right? You got 30 days for it to work out, and that's the scenario. So here's a different adjustment where you don't bring in quite as much premium, but you have a little bit more upside. And these are the things that you have to I hate adjusting a trade that's going to lock in a loss, right? I hate adjusting a trade that is going to lock in a loss. So if I adjusted this trade to a position where my cost is higher than my reward, Well, I guess you could say you get the stupid award for that. An adjustment is adjustment, and it still gives you a chance, to get some money back. But if you're adjusting, you're down on the trade, right? So I don't mind this one, and it's all about, um, is this enough premium? Is this enough premium to say I would rather adjust it than get out and be done with the position? And that's actually, I kind of like to do this, especially with the beginning traders, to teach this because they have such a hard time taking a loss on a trade that this gives them some money back, but doesn't, get them out of the market. So they're usually little bit more comfortable with doing this than just saying, okay, I was wrong. I'm out of the market. I'm going to lose my $5 and move on to the next earnings event that is happening. All right. So if you switch this up, this 185, and you go to the 190, well, that's an interesting trade. In my mind, it's a more interesting trade, okay? Because now you're bringing in 188, but you have a 15-point wide spread. So still have so let's call it $2, right? So you put it on for 12. You can bring in $2, which is, aggressive, I guess. But if you bring in $2, you have $10 of total risk, and you have a 15-point wide spread. So you could still make $5 on it, right? I'm not anticipating that it's going to go to 210. And why not take the profit on this? By the way, you will be taking a profit, right? You've sold this for $2. You're going to take it off for 45 cents. So you did make a profit on that. And now, and that's in the books. That's done. That's a profitable short option position that you took off. But you could do this. So these are the two trades. You can do the 185, bring in $1.88, or you just say screw it, I guess, and just let it run. But you bring in $1.88. I like this one, even though it's a little bit less. I'm not thinking it's going to get to 210 now by October 3rd, but I you still have this potential. I really wanted to just be able to get out of the trade, especially with September and October coming. And then the next trade is to go down to the 185 like this. And this is all because we got time left. It's all because we went out far enough in time. That's the reason why we can do this. Bring in 315, or you do none of it and you just close out the trade and pull in the $7 approximately and say, I'm done. It's over with. All right. Any questions on that? If you have any questions, do please put them in the chat box, and I'm happy to try to address them during the show. All right. So the other trade, and I kind of got this one screwed up a little bit. Maybe I'll just start from scratch. Yeah, that's what's up. Setting this one up. $109. Let's go and send that to ticket. This is the September 5th trade. So we still got some premium left in the 180s. You could get out of this for 109. I think that we paid about $4.50 for the trade. So you still have a possibility. Obviously, this market can come back easily. And like I said, NVIDIA is probably more down with the market than it is to anything to do with earnings. Company still looks extremely solid across the board. So we're trading at 180 to 195. We still have this upside. If you wanted to, you could take off this risk. You could take this off right here and take these two trades off and just sit on the 180. And then if you do get a move up, you can actually sell some premium against it and try to get a little bit, once again, turn this into a long call spread saying, I don't want the cheese anymore. Just let me out of the trap. So you close this out today. Monday, the market bounces back. Maybe you can sell the 190 for, I don't know, $1. Hopefully you get a little bit more than 16 cents. But right now, the only suggestion that I would have here is think about taking off this risk right here, which costs you 8 cents and 3 cents total. you got to do 8 cents twice and then 5 cents once. 16, so 11 cents. It's going to be 11 cents. Well, I guess we'll just set it up. And we'll do that real quick. Okay. 12 cents. So you could close that for 12 cents, get rid of any issues if the market goes up, or you could just let it ride, or you could just close the whole thing and take the dollar. You only have 7 days in this trade, so the adjustment isn't as exciting, but it's completely up to you. Do you think this is a start of a bearish trend? Is the Fed not going to cut now? I haven't looked at what happened with the Fed funds as of yet. I meant to do that today. See if that adjusted at all the probability of a rate cut based off of the information this morning. I can do that real quick. Like I got a different screen over here. Fed funds futures. Let's see where we're at. And then let's put on our new trade. And by the way, Monday is a holiday. So we got 19 days until the Fed has we're still at 89% chance of a 25 basis point rate cut. That is correct. 90% chance. So that didn't really move at all. What was it a day ago? As a matter of fact, it's now, it went up. I guess the market took the news as it's more likely now. The Fed yesterday it was at 86%, and now it's at 89%. The odds of the rate cut. Who knows? That's where we're at. We're going to leave it there. Let's do our SPX trade, and I'm going to put this one on today as soon as I get off the phone. So I need to get off the phone because we're pushing against that 11:30 hour, and like I said, every half hour matters. 0 DTE. I'm gonna whatever I do today on this trade, I am going to show it on Monday. I'm going to put a PowerPoint together. I'm going to make an education Monday for the holiday, and we're going to talk about the trades that we've been doing. And today I'm going to have this one on my account, and I'm going to get out between 2 and 3 o'clock, as I've always said every day on the show. So here we go. We're leaning bearish, and I don't mind leaning bearish at all today. We had the big news event coming up. It would be nice if the market would just kind of hang around right where it's at. So let's put this together. We're right at 64.56, 64.55. All right, we're going to buy this. I'm going to sell 2 of these, and we got some premium. So this should be a decent trade in that the VIX has jumped up today because of the down day. Okay. Sell 2 of those and stop short on this one. 320. Yep. So not a bad price. I think Wednesday's show, we were like looking at $4. That's the difference in volatility, especially short-term volatility. Now, remember, the VIX is 30-day. So it's not looking at it helps, gives you an idea. Obviously, the market's down, the VIX is up. But this is not a bad price. And so I'm going to actually execute this trade. So I'm going to have to run. If you have any questions, let me know. I'm going to go put this one on, and my findings are going to be displayed on Monday as to what happened with this trade. I'll just look at it on a 1 contract basis. You can multiply it by whatever number of contracts you would want to do. Always want to put that in your hands. I don't ever want to imply what number of contracts you should do overall. Oh, there it is. All right. And I don't see any questions. So have a good weekend, everyone. Enjoy, get out, relax. Weather here in Charlotte, North Carolina is just gorgeous. No humidity. The hurricane came flying through, and Hurricane Aaron, and took all the humidity away. So we got a beautiful weekend, and I plan on enjoying it. And this Monday, please tune in. We're going to have an Education Monday. It's going to be a show all about the 0 DTE SPX trades. And then we'll be back on Wednesday live again for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.